Hello sector watchers, welcome to the show. This is the 196th episode of Sector Spotlight for Tuesday the 7th of November. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. After two episodes of Sector Spotlight last week, one for seasonality and one for completed monthly charts, I want to do for this episode a quick overview of what's going on in the various rotations, take a quick look at SPY, S&P 500, and then present a way to compare equal weight and cap weighted sectors using relative rotation graphs in a slightly different manner. So stay tuned, this is Sector Spotlight. Let's take a quick look at the charts of SPY, the daily and the weekly, to kind of get the bigger picture framework of what we're dealing with nowadays. On the left hand side I have the daily version of SPY, and on the right hand side I have the weekly chart. And in my view, the first thing that we need to acknowledge is that I think in both cases the rhythm of lower highs and lower lows is still in place. So on the daily I'm looking at a high, a lower high, here maybe, and definitely a lower high. And we haven't broken above that previous high yet. So the lower highs are still in place. And so are the lower lows, because I'm looking at the in-between lows, which means this low here, those two bottoms here, to me that's one low. These two here, that's one low, and then obviously what we saw a week ago, a little bit longer, is another low. So the rhythm of lower highs and lower lows is in place. And you will see the same thing on the weekly chart. So here's the high, here's the lower high, here's another lower high, and we still haven't pushed beyond that previous high. And here the lows are a little bit more pronounced, better visible, because they're condensed in the weekly bars. So lower highs, lower lows is still in place. Now, where did that last low occur? First of all, I think I've got it like orange shaded in both charts. That was the target range that I put in there after we completed that head and shoulders pattern. So we broke it here with that gap, declined, found support at, again, a very nice historical level, bounced back up to the neckline, which started to act as resistance, and then we touched, albeit barely, but we did touch the upper boundary of that target area. And here you will see the same picture, the same image when you look at the weekly chart. Break of the neckline, find support, rally, old support neckline functions as resistance. We go down again and we reach the upper boundary of that target area. I have adjusted my longer term trend line slightly to bring that new low into the mix, because I do feel that it is an important low. It's a major low, as you can see here. So I feel that it's justified to adjust the angle of the trend line, where it now connects 1, 2, 3, and I'm going to say 4 here, because if you look at the closing prices, they're all in that cluster area. So for me, that's the real low, not that spike down. That's not, well, obviously it is a low, but the real support, the real demand, which is driving those lows, was set in that area around 357, 360. So what are we looking at right now? Obviously, that old neckline that is acting as resistance is coming back into play. And it's kind of coinciding with the previous high, and it's labeled here, it's 436.29. Let's say for 436, let's round it off at 440, because the line is angling up slightly. So I'm now going to watch 440 in SPY as a major resistance level. There's a lot going on, obviously. It's not a very clear trend, nor the downtrend, because that is getting under pressure with that last rally, because it's very steep, nor the uptrend that we have here, because we had to angle down that trend line. I mean, it was a nasty move that we saw a couple of weeks ago. So we're still in caution mode probably. But I think the most important takeaway is that the imminent danger of a really rapid decline has now faded. There's always the risk's always there when you're in a downtrend, lower highs, lower lows. But I think that compared to where we were like a week and a half ago, the risk has kind of been mitigated at least to a degree, and there is now again quite a bit of room for SPY to decline without breaking to new lows and kind of confirming the existing downtrend. Another thing that helps is the fact that the RSI, as you can see here, has really jumped, which is obviously a good sign. It's above 50 again, and you can see that in more detail here on the daily chart of the S&P 500 or RSI on the S&P 500, and you can see that the MACD has started to turn back up. So all in all, the outlook for the S&P remains cautious but mildly positive, because we haven't really cracked on the way down. And as long as that's not happening, I'm going to take it from a mildly positive view and stay with a longer term positive outlook for the S&P 500. Having said that, let's take a look at what's happening in sector rotation. As I said, I want to take a look at the current rotations, but also pay attention to the differences between the rotations in cap-weighted and equal-weighted sectors. Because, especially in times of uncertainty, volatility, unclear rotations, I think those types of comparisons, and whether that is equal weight cap-weighted or large cap versus small cap, growth value, all those types of rotations, you can kind of get a little bit more information out of it and use it as pieces of the puzzle to paint a picture of what's going on in the markets. Now, here we have the cap-weighted and equal-weighted RRGs for the cyclical sectors on the screen. So here on the left, we have large cap cyclicals, and here we have equal weight large cap equal weight versions. And obviously they are compared to the S&P, which is the large cap index, and here is RSP, or the cap weighted large cap index, and here is RSP, which is the equal weight index. This could be SPY as well. It doesn't really make the picture so much different. Anyway, now what I want to do is just go over these tails, and I'm going to sort them on names so we have them side by side. You got consumer discretionary, and here you got equal weight consumer discretionary. You can see that equal weight is further down the line in terms of lagging the index here as well. Then we can do that for financials, and here's financials, and you can see that the small caps are way to the right compared to the large cap, to the cap weighted. So equal weight is way to the right compared to the cap weighted version. Here's materials. They're kind of in the same boat. Equal weight is a little closer to the benchmark. And here is real estate. And you can see that the cap weighted version rotated through a weaker period, where the equal weight version was kind of stable over the last 5 weeks we're looking at. So in this respect, comparing the positions of these sectors is not a huge difference. Maybe financials. So financials are the takeaway for financials could be that equal weight is further to the right, so that's outperforming the equal weight sector, and financials is kind of in line with the benchmark, with the S&P 500. These are the major names. They're there. So the takeaway would be that not the largest stocks are doing better than the large stocks, because the large stocks are obviously driving that financial sector more than they are doing that here in the equal weight, because right here they have all the equal weight. So as soon as you take away the impact of the large cap stocks, you will see that the financial sector is actually doing a lot better compared to its own equal weight index. That's the way I usually read these charts, these comparisons. Now if we do something similar to the defensive sector, then I think there's one thing that really stands out. That's the improvement for the utility sector. It's getting in line, but it's doing that. These both are 5 weeks. Oh, this is 10 weeks. Sorry about that. So here is 5 weeks. They are totally in line with each other. And then here is staples. So the real difference here would be between XLV and RSPH, which is the healthcare sector, where you can see that equal weight is moving up and cap weighted is coming down, but it seems to be stalling right now. But the trend, the tail on cap weighted is coming down, tail on equal weight is going up. So the takeaway here again would be that the larger cap names, the larger names in the healthcare sector have been pushing the performance down, have been underperforming the S&P 500, where the smaller names, because that is what's driving that RSPH tail, have been going up. So there would be a preference for the smaller names in the healthcare sector, reading it from these charts. And then finally, there is the economically sensitive group. Let me bring this to 5 as well, just be honest. And there you can see how energy is in both comparisons inside leading but moving lower. You will see communication services. Oh, come on, yep. On the cap weighted, it's moving from weakening into leading, so that means that the larger names are driving this sector higher. And you can see that the equal weight version is on a similar trail, it's on a similar path, but it's coming from the left-hand side. So the smaller names, the not mega cap names, are catching up and now moving into the leading quadrant. It means that the communication services sector in both comparisons is a pretty good sector as a matter of fact. And then if we look at industrials, then you can see how the large caps are actually already pushing into the lagging quadrant, or the cap weighted, driven by the larger names, where the equal weight version of the industrial sector is still inside weakening. They're moving in the same direction, but the drive is coming from the larger names. So here, I would actually focus a little bit more on the smaller industrial names, on the smaller names inside the industrial sector. And then we've got the technology sector, and in both cases it is inside weakening, moving towards leading, but it looks as if the last few weeks this is actually now starting to hook down. It's actually this week. Yeah, this week is, so I'm recording this on Tuesday morning before the market opens, and you can see how that tail has just, based on yesterday's price movement, has already hooked back down, and the same is happening in the cap weighted sector, albeit to a lesser degree. So my initial take from this is that the larger technology names are outperforming the smaller ones, because the tail on XLK looks slightly better than it looks on the RSPT, which is the equal weight version of this comparison. Now, while doing this, I constantly am trying to figure out, where should I be? Should I be in the cap weighted or in the equal weighted version? Pretty much making the decision on, do I want to concentrate on the larger cap names, meaning sticking with cap weighted sectors, cap weighted ETFs, or is it better, would it be better to mitigate the additional exposure to the large cap names as it is inside the cap weighted sectors, and move to the equal weight version? And this kind of analysis using RRGs will help you, but the problem is that we are comparing those sectors with different benchmarks. So we're comparing it with the S&P, obviously, for the large cap sectors, and we're comparing it with RSP for the equal weight sectors. And it'll give you an idea. I mean, it's not completely useless. It'll give you an idea about what's going on and give you a high-level idea. But my mind's always kind of racing to figure out if there is a better way to do something or another way to do something or a different angle to look at things. And what the thought that crossed my mind, and I wasn't even sure whether the system could handle it, because in essence, what you really want to do is look at the, for example, here is still on the screen XLK and RSPT. What you really would like to do is compare XLK and RSPT together, just as one. But again, then you have the classical problem of relative strength analysis. We can do that without a problem, just putting up a ratio chart or put in the RRG lines on XLK versus RSPT, but it will give me the outlook, it give me the answer on only the comparison of XLK versus RSPT of that ratio. So what I wanted to try and do is see if I could play around with the ratios, so RSPT versus XLK, on an RRG, and then figure out what kind of benchmark I want to use. And that's what I'm going to do in the next section. The first thing that you will need to deal with when you start doing those, I don't know, comparisons of comparisons, is that your benchmark, what benchmark are you going to use? As I said, you could use SPY or you could use RSP for the comparisons, but is that a fair thing to do? Question mark. I don't know. I haven't. The jury's still out on that one. Let's say it like that. But what I really wanted to do first is figure out, because when you do these sector comparisons, you need to do the same level of comparisons at the benchmark level. So that means SPY versus RSP. And on the left-hand side, I have my regular setup, my default chart with, in this case, the S&P 500 SPY. And I've changed my benchmark symbols to RSP. So this is the chart of SPY, and then this is the ratio of SPY versus RSP, and these are the RRG lines. And from a very quick take, this means that if we would create an RRG with RSP as the benchmark and SPY rotating around it, SPY is now inside the leading quadrant. Both RRG lines are above 100, and it's pushing further into it, clearly saying that large caps are now the preferred group. And you can very easily see that. You don't really need an RRG for that if it's just a one-on-one comparison, by looking at the ratio chart here, which is going almost straight up, very steep, very regular uptrend. And it's reaching the levels at which it was back in 2020. And you can see what happened in 2020 when it rolled over. Now, I'm not going to say that this is a foolproof kind of risk on, risk off indicator, because it isn't. I've studied these charts preparing for this show, and I couldn't come up with a real clear-cut trading rule setup. But when I did a longer term comparison, and that's the one on the right hand side, that's the monthly chart of SPY versus RSP. So that is basically this chart here, the chart in this pane, magnified in the upper pane. And here, because you are at very high levels. I mean, this ratio goes back to 2003. That's when RSP started trading. So before that, we didn't have any data. But you can see that we're almost at the highest level where we were. And what I've learned is, if it's unclear where the levels are, the first thing that you do is go watch and go look at rate of change. Because the relationship, the rhythm, the underlying rhythm in these type of comparisons might not be the comparison itself, but the rate of change of the comparison. And when we do that, you get the chart that is below here, and you can see how we are now pushing to the highest rate of change almost in the entire history of, well, what we have data of. And if you look here, then this high was set somewhere in April 2020 when it rolled over, and SPY started to underperform equal weight started to outperform. That's when we had that massive rally. If we do the same thing here, we had a situation back in 2008 where at the end, so during the whole havoc of the financial crisis, large caps outperforming equal weight, and then at the end of 2008 and the beginning of 2009, that's when the new rally started. That's when you see that equal weight is starting to rapidly take over from cap weighted, from SPY. Not saying that that's going to happen again, but I thought it was an interesting observation that we are approaching the same types of levels where we were before basically the start of the most recent strong rallies, and that's both in terms of outright comparison as well as the level of the rate of change. As I said, what you really need to do or really want to do is look at the ratios itself. And what I did is I created, or I set up an RRG, and now bear with me because this is it's not complicated, but you got to pay attention. So here the inputs are the ratios, and if you look closely, and let me see, I can magnify that here, you can see that here is XLC colon RSPC and then comma, and then XLY colon RSPD comma. So I did that for all 11 sectors. So we're putting in the ratios as the securities. And what you will get then here, you'll see it in the table below the chart, you will see the ratios. And what I've also done is I've put the benchmark as SPY versus RSP. So what we are looking at right now are the ratios, so the performances of the cap weighted versus the equal weight sectors against the benchmark that compares cap weighted versus equal weight. And with that information, we can now very rapidly see that among all these ETFs, you really want to be, let's say, overweight, healthcare cap weighted, staples cap weighted, discretionary cap weighted, and communication services cap weighted. Technology cap weighted is coming. All the others, so that's financials, materials, utilities, industrials, energy, real estate, you want to be in the equal weight versions. So that's the quick takeaway of this setup, this RRG, is that you can very rapidly see in which area you want to be in the cap weighted and in which area you want to be in the equal weighted. What you are essentially doing is trying to outperform the ratio of SPY versus RSP. And now it becomes difficult because this doesn't necessarily mean that the prices of these ratios are going up. It only means that they're going up faster than the ratio of the benchmark, or they are going down less fast than the ratio versus the benchmark. So it's a bit of, there's a lot of moving parts here. And although I do feel that this chart gives you a good view on inside the universe where you need to put your focus on the cap weighted sectors and where you need to put your focus on the equal weight sectors. What dawned on me is that we are looking at comparisons. So we could potentially trade this with a market agnostic view, meaning that we don't need to know where the market is going to benefit from knowing where that ratio is going. So if you look at, I think that XLK versus RSPT right now is a pretty interesting chart because you got that rotation going up, it's picking up speed, looks really nice. So for me, this would mean I want to be long XLK and maybe short RSPT, or put on some kind of an options trade to benefit from XLK outperforming RSPT with an agnostic view towards the direction of the market as a whole. And obviously we always use $1 to achieve that, to achieve real-time trends. And when I do that with this kind of setup, then I get this chart. And what you see here is interesting. You see these are the exact same ratios, the exact same groups that, that I have on the RRG. But instead of having the ratio as the benchmark, I now have $1 as the benchmark. And what you see is that this is clearly shifted to the right. And to me, that tells me that the majority of these ratios are to prefer the cap-weighted, to prefer the larger stocks in those universes, because here you can see that on the right-hand side there's a majority of the ratios. That means that all these cap-weighted sectors are outperforming, or all the ratios are outperforming $1. So they're all in favor of those cap-weighted sectors, where you can see a quite different picture when you compare it to the ratio benchmark. So both charts give you valuable information. The left one with the benchmark, the comparison as the benchmark, will tell you which sectors to overweight in terms of cap weighted and equal weight. That'll help you, in this case, to outperform the comparison of SPY versus RSP. And if you switch to $1, it gives you a market agnostic view, and it'll help you to come up with trading ideas to pair cap-weighted versus equal weight sectors without having to worry about the direction of the market as a whole. So if I zoom in on this chart here and see if we can find some nice, so here's that XLK RSP T-tail. Look at that. That's a very nice rotation, and I think a pretty strong and solid trade idea right there. If you look at XLV, so here you got consumer discretionary, and that's the same as technology. You can see how the larger names, so the cap-weighted names, are outperforming the equal weight names. You see Staples is rolling over, the stack again. Here is materials, same story. You can see how the cap-weighted is outperforming the equal weighted. Here is industrials, same story. Pay attention to the length of the tail. So I would very much prefer a tail like technology, because that is a long tail indicating that there's a lot of power behind it, over the industrials tail, which is very short and you know, it's going in the right direction, but there's not a lot of power behind it. So here's energy, and this is interesting because this tells me that I probably am better off shorting an XLE and being long RSPG, or inside a portfolio prefer RSPG over XLE. And then we have the comparison of real estate, so XLRE versus RSPR, and that definitely is in favor of XLRE. So the cap-weighted ETF way outperforms the equal weight ETF. Very, very good preference for XLRE. We go to XLC, then it's on the right-hand side. So in general, one would say that cap-weighted is outperforming equal weight, but you can see that it has just started to curl back down, or hook back down towards the lower left-hand corner, which would kind of suggest that that move is starting to move in favor of RSPC over XLC, but it's a little early, it's way to the right. So in general, XLC is still to be preferred, but this is one that I would keep an eye on. And then we have financials, and you can see how this has started to move in favor of XLF, so the larger cap names. A little hiccup to the left, but I think that overall, in general, we can conclude that the larger, the cap-weighted names, cap weight is to be preferred over equal weight, because this tail is driving the market higher, is driving that ratio higher. And then finally, there is utilities. And as you just saw when I did the other comparisons, that was the utility sector as a whole is moving towards that top right-hand corner, so pretty strong. But if you look at the ratio, then not a lot is going on. If you let me isolate that for you. So here's isolated, and you can see how it has been sort of stable and stationary, very close to the benchmark. So here, it doesn't really matter whether you are in the cap-weighted or the equal-weighted ETF. And you know, knowing that utilities is one of the smaller sectors, that is very understandable and you know, makes total sense for this ratio to not differ greatly. You will see when you do this type of exercise, you will see the bigger moves in the larger cap sectors, because that's where there is a big difference between the top names and the bottom names in terms of market capitalization. Anyway, I want to wrap it up here. I thought it was an interesting way of using RRGs and an interesting way of using ratios on an RRG, and give you another thing, another toy, another tool to play with and see whether you can come up with different angles of looking at the market, different ways of slicing the sector universe, and figuring out which sectors to prefer, but in this case also which instruments to prefer, cap weighted or equal weighted. And this wraps up episode 196 of Sector Spotlight. As you know, Sector Spotlight is available on demand on the Stock Charts YouTube channel, usually recorded and uploaded on Mondays. Today's Tuesday. As usual, feel free to share your thoughts and ideas and the comments below the video, or contact me on any of the handles on the screen. A like and subscribe is appreciated, and I'm looking forward to seeing you again at a new episode of Sector Spotlight next week, same time, same place.